This is FRM Part I, Book 3, Financial Markets and Products, Chapter 4, Introduction to Options, Futures, and Other Derivatives. I hope I can convince you at the end of this slide deck that derivative securities are really about the coolest thing out there in financial markets. This is how I want you to think about derivatives and derivative securities. We know that there are secondary spot markets out there, like the stock market and the bond market and the commodity market. The participants in those markets are businesses and corporations and farmers and others, of course. And you and I can participate in these secondary spot markets as shareholders and as bondholders. But when we participate in those markets as investors, we have to put up lots and lots of our own capital. Wouldn't it be awesome if there were an outlet where we could take a position in those secondary spot markets that would only cost us a fraction of that investment? And that's what derivative markets are. I want you to think of these spot markets over here, like the floor of the New York Stock Exchange. And then I want you to think of these derivative markets over here. And some of them are organized exchanges and some of them are over-the-counter markets. But these derivative markets, they trade assets whose values are derived from the value of those assets traded over in the secondary spot markets. And so what you can do in the derivative market is you can take a position. So think about it like this. You're in the derivatives market and you're peeking over to the secondary spot market and you're saying to yourself, okay, there's a share of stock and that share of stock is increasing in value. If I went to the New York Stock Exchange, I might have to pay $100 or $200 per share, but I can take a position in a derivative over here on that same security, and it might only cost me $1 or $2. In fact, in some instances, there might be no cost at all. And if that particular stock increases in value on the floor of the New York Stock Exchange, then we would win over here in the derivatives market. And so think of derivative markets as markets in which they trade securities, like an option contract, like a futures contract, like a swap contract, in which the value depends on what's going on over in the other secondary market. All right, let's get into the learning objectives here. We're going to do some describing over-the-counter markets and exchanges, look at the advantages and disadvantages, differentiate between and among options and forwards and futures contracts. And we're going to identify and calculate some payoffs, talk about hedging and speculative strategies. Once again, look at arbitrage, talk about some risks. I've had to sneeze for about the last 30 minutes, so I think that'll be the only one. All right, where are we? We're at the end there. So let's get right into talking about these derivative markets. All right, so what is the over-the-counter market? It's a decentralized trading platform. Of course, remember that organized exchanges, those are physical places to trade, like the floor of the New York Stock Exchange or the Chicago Mercantile Exchange. But over-the-counter market, this is decentralized. There's no central physical location. So market participants then use all sorts of communication channels, like their phones. I remember one of the first times I took my students to New York City. We went to the New York Stock Exchange and we went to Prudential Securities, where we looked at all these market makers and they all had their little handheld computers and they were trading and doing all sorts of really fun stuff. Now, in the OTC market, it's possible, in fact, quite likely, that two participants who are going to trade products and securities are going to do this privately without anybody being aware of the terms, including the price. I mean, on the floor of the New York Stock Exchange, this is transparency at its best, but the OTC markets are not quite. Now, historically, of course, stocks traded in the over-the-counter market were typically smaller companies, and then when they got bigger and bigger and bigger, then they would kind of graduate to the American Stock Exchange and then graduate to the floor of the New York Stock Exchange. And of course, that doesn't happen anymore at all. There's intense competition between the NASDAQ market and the New York Stock Exchange. But nevertheless, think of OTC as, kind of the general decentralized trading platforms, and then organized exchanges like the New York Stock Exchange and others. Advantage of over-the-counter trading, fewer restrictions, freedom to negotiate, and it's cost-effective. Disadvantages, there might be some increase in credit risk and maybe a lack of transparency. All right, let's dive into these things. Option contract. This is really cool. This is what I always tell my students. An option gives the owner the right, but not the obligation to do something. You know, whenever we typically sign a contract, whether it was our interest rate forward contract when we bought a house and took out a mortgage loan, you know, we signed a contract that said, you know, our interest rate is 6%, we'll close within 30 days or 60 days or whatever. What we were doing is we were signing a contract. We were legally bound to trade at that interest rate, regardless of whether interest rates go way up or way down in that intermediate time period. But an option is really cool. It gives you the right, but not the obligation. And this is what I tell my students. It gives you the right to do nothing. And the right to do nothing has tremendous value. That's why lots of times we're willing to pay a substantial premium for options, because sometimes the value of that underlying stock in the spot secondary market, that underlying asset, moves in our direction and we don't need the derivative security. All right, so let's look at the two kinds of options. There's a call option. So a call option gives the owner the right but not the obligation to buy an underlying asset at an agreed upon date at the strike price or the exercise price. So if you buy a call option, what you're betting on is that the price of the underlying security increases. Let's go back to that example that I mentioned earlier in the slide deck. Let's suppose we have a stock that trades for $100 on the floor of the New York Stock Exchange. Well, if you wanted to invest in that stock, you would need to come up with $100 today. But if you go over to the derivatives market over here, maybe you can only buy that option for $1 or $2 or $5. So you have a position. If the price of that stock goes up, then you win. Put option, on the other hand, is just the opposite. You know, this is what I do to students all the time. It's just the opposite. It gives the owner the right but not the obligation to sell an underlying asset at a strike or exercise price by the expiration date. Of course, if you buy a put option, you're betting that the price of the underlying asset will fall. Now, I mentioned a forward contract. There are typically two types of forward contracts. There's an interest rate forward contract, which we sign for our mortgages, and then there are currency forward contracts. And the interesting thing about these is that they're non-standardized. And so two people could get together and say, hey, you know what, Jim, I like your financial calculator. Where's my financial calculator? Look, I got the old financial calculator. Hey, I really like that calculator. I don't need it for 6 months. I'll pay you $100 in 6 months. And so we could sign a contract, and so I could agree to sell, and this other person could agree to buy. And so what are the terms? The terms, what did I say, 6 months and $100, and it's for this particular calculator, right? These are standard, non-standardized contracts that are typically traded in the over-the-counter market. And so there is a long position and a short position. One person is betting that the price is going to rise. That's the long position. And one person is betting that the price is going to fall. That's the short position. Now, in my calculator example, I'm agreeing to sell my calculator for $100. And so I'm hedging myself that if the price of that calculator falls down to, let's say, $50, I have this contract in place so that I can sell it for $100. On the other hand, whoever's buying that calculator from me is betting that the price doesn't go to $200, or if it does go to $200, then he or she can force me, remember it's a legal and binding contract, to sell my calculator for $100. Now, of course, let me give you a quick history lesson. Those of you who are following along on my videos know that I love history, among other things, is that these forward contracts have been a huge asset to the development of our economics in our country here in the United States, especially going back, like 150, 180 years ago. Farmers would get together and they would sign these forward contracts, but they had so many risks because they were non-standardized. There was no secondary market. That's why in 1848, there were a bunch of these guys, I think it was 12 or 15 guys, they got together and they said, you know what, we're watching these farmers out there have to sell their farms or sell their horses or sell their goats because they couldn't deliver on their forward contract. how about if we standardize this forward contract and create a futures contract? Oh my gosh, this was so cool. So a futures contract it's exactly like a forward contract, but it's standardized. All the terms are standardized. So look at that last bullet point there. Standardized, legally binding agreement between two parties that specifies the price at which to trade at a specified future date, and they're going to trade on an exchange. What that means is, since there's so much activity going on this exchange, that if one side or another, the long or the short position, wants to get out of that contract, they can just show up on the exchange and offset that position. So that's the big difference between the forward and the futures contract, the standardization terms. Now, futures contracts then also have clearinghouses. So you go to the exchange, and you don't really find somebody on the other end of the transaction. I mean, if you're a farmer and you're growing corn, you're not going to go to the exchange and say, okay, I want to sell my corn to that person over there. You write a contract with the clearinghouse, and the clearinghouse then writes a contract with the person who wants to buy your corn. And so think of it as kind of just the middle man or the middle woman or the middle person, so that both parties know that there's liquidity in there and there's substantially less credit risk. In fact, sometimes there's no credit risk. Now, the other cool thing about futures contracts is that there is this concept of daily settlement. There is marking to market. And so at the end of every trading day, each contract is marked to market, which just simply means that whatever its value is, then that's the value. And if there's a winner and a loser, then those two have to exchange capital. Here's the two quick examples that I like to give my students. If you buy a share of stock on the floor of the New York Stock Exchange, say for $100, and tomorrow it goes up to $101 and you don't sell, well, you can tell people, say, hey, I made $1 on the floor of the New York Stock Exchange today. But that's an unrealized gain. In these futures markets, these gains are forced to be realized at the end of every day, marking to market. Let me give you one movie example. Of course, the famous movie is Trading Places with Eddie Murphy and Dan Aykroyd, where they traded orange juice futures contracts. And remember, at the end, Eddie Murphy and Dan Aykroyd, they shorted the orange juice futures contracts. So when the price fell substantially at the end of the trading day, they made tons and tons of money, enough to buy an island and some big boat if you look at the end of the movie. But right there on the end of the movie at the exchange, Mortimer and Randolph Duke say to the mercantile exchange officers, they say, turn these machines back on. And the dude says, we settle contracts at the end of every day. You owe us $476 million, or whatever that number is, some huge number. Marking to market. Now, of course, since we're agreeing to trade at some point in the future, we're not going to exchange capital. I mean, the guy who's buying my calculator from me, he or she, he's not going to pay me money today. We agreed to trade $100 in 6 months. Now, of course, for this liquidity and for the clearinghouse and for the marking to market to work, there has to be some type of an injection of capital. And so these exchanges require margins. So what each party, the long and the short position, have to do is they have to put up some of the capital, a percentage of the capital. Maybe it's 2%, maybe it's 5%, maybe it's 10%. But the exchange and the financial institutions, they get to determine that based on the volatility of the underlying asset. But the important part is that margin it's your money. You're not paying a premium like you are for an option. Let's look at a quick example here. We enter into a long position in a coffee futures contract for $520.50 per bag. Each futures contract controls 100 bags. All right, so there's part of the standardization. So each contract for coffee is bags. It's 42,000 gallons of gasoline. It's 5,000 bushels of corn, 5,000 bushels of wheat, 110,000 board feet of lumber, et cetera, et cetera. So those terms are standardized. All right, so there's an initial margin of $5,200 and a maintenance margin of $4,700. All right, at the close of the trade on the first day, the futures price drops to $512. So we're the long position, right? In our example, we're betting that the price goes up. So we're wrong, right? Well, the price went down, so we have to lose. So at the end of the day, what must we do? So we take the difference between our 520 and the 512, multiply it by the standard amount of the contract. That gets us our loss of $850. All right, we have this new margin. We had our margin of $5,200 minus that $850. That gets us down to $4,350. So we're below the maintenance margin. So we have to inject another $850 to get us back to that $5,200. All right, so what did we do when we originally entered into that long position? Right away, we're required to put in $5,200, just like the short position is. And I can do this here in Pennsylvania, and because of the way the clearinghouse works, that short position could be somewhere else in Pennsylvania, but it could be Santa Claus at the North Pole, or it could be anybody, because that clearinghouse will write two separate contracts. So then when I lose $850 during the day, then I have to go to my broker at the end of the day and say, here's 1, 2, 3, I got to count out $850. And then that $850 will magically appear in the short positions account. And that short position can take that $850 and go and buy a new iPhone or something, or whatever he or she wants to do with it. Now, the cool thing about this is that we probably have treasury bills in our portfolio. We probably have a money market mutual fund account somewhere with our broker, and so the broker will actually just switch our funds at the end of the day. All right, how about contract payoff? So here, let's look at the payoff for a call option. So let's look at our terminology and our notation here. So there's the call option payoff on the left-hand side of the equal sign, and it's going to be the maximum of either 0, because we're betting that the price goes up, but if the price falls, then we're not going to exercise our option to buy at that higher exercise price. We could just go to the New York Stock Exchange and buy at that lower price if we want. So the most we can lose when we buy the call option is the entire option premium, which means the payoff will be $0. Now, what can we win? We can win the difference between the stock price at maturity and the exercise price. And so let's just take a quick example here that if we buy an option today and the stock price is $100 and the exercise price is $100, and on the expiration date the stock price goes up to $140, what do? We exercise the option. We have the right but not the obligation to buy at 100 when the price is now $140. And so what happens is that our payoff is going to be $40, because we may or may not want to actually own the share of stock. Remember, we're over here in the derivatives market. We're peeking over to the floor of this secondary spot market. And so what we know is that almost all, 98 or 99% of all derivative contracts are settled with cash. And so we just get our cash, our $40, out of the derivatives market. And then, of course, we'll do the opposite here for a put option. Oh, you know what? Let me go back here and say, suppose that stock price drops to $50 a share. What are we going to do? We're going to allow the option to expire, and our payoff is $0. All right, now to the put option. Let's suppose we have that same example, and stock price of 100, exercise price of 100, and now the stock price falls to, let's say, $10 a share. This is good news for us owning the put option. So now what do? We exercise the put option. We have the right to sell at 100 when we would only be able to get $10. So our payoff is going to be the difference between the exercise price of 100 and that $10 of the stock price on the expiration date of the contract. So we're going to get that $90 in cash out of the derivatives market. On the other hand, if the stock price goes up to 200 or 300, what do? Well, we have the right to sell at 100. Why would we sell at 100 if we could sell at 200 or 300 or whatever those numbers were that I say? So we allow the put option to expire. Now, the forward contract payoff to the long position is very similar. So all we're going to do is take the difference between the spot price at maturity and the delivery price, which was determined when we signed that original forward contract. And so what was my example here? I said we agreed to trade at $100 for my calculator, right? And if the price is $200, if the secondary spot price of these old time HP 12 C's is $200, then that payoff is going to be $100, because that person who signed that forward contract, he or she may or may not want to buy the calculator. They just might want to bet on the price of the calculator. All right, derivative markets are really fascinating vehicles for hedging. So think about this. For a hedge to work, you have to have a position in this spot market. What you do then is you go to the derivatives market and you take an offsetting position. You have a position in the spot market, and so you take an offsetting position in the derivatives market. So here are two circle point examples. An investor with a long position in an asset can hedge that exposure by entering into a short position in a futures contract or buying a put option. An investor with a short position in an asset can hedge the exposure by entering into a long futures contract or buying a call option. I always give my students examples of farmers or oil people, or a company like Southwest Airlines or Kellogg's. Let's suppose you're the farmer and you have 5,000 bushels of corn. What's the worst thing that can happen to you as the farmer? You plant the corn today. You expect to harvest the corn in, 2 or 3 months, and you expect to sell it for, some amount of money. Let's just suppose you're expecting to get $10,000 for your harvest. Well, that $10,000 in the harvest depends on what that future spot price of corn is going to be. If the spot price of corn spikes by the time you're harvesting, this is great news. You get to sell your corn for a higher price. But if the price of corn drops, suppose it falls to $0, then what do? Then your corn goes to waste. This is called commodity price risk. And so think about it. A farmer's fortunes and future depends on the price of this commodity. So what can a farmer do? A farmer is naturally long in the corn market because the farmer benefits when the price of corn goes up. So in order to hedge, the farmer is going to take the short position in a corn futures contract so that if the price in fact does fall, the farmer will then sell the corn at the lower corn price, but go over to the derivatives market and take out lots of cash to make up for those losses. Southwest Airlines does this. Kellogg's does this for corn and wheat and whatever else they put into Count Chocula. And so lots and lots of companies hedge. Now, you can hedge with a forward contract, you can hedge with an option contract, you can hedge with a futures contract. In fact, there are some times, this is so cool, there are some times when you can actually have a perfect hedge where you lock into the future value of your underlying asset. Let's look at a currency example here. Let's suppose a U.S. company is scheduled to receive 10 million pounds in 6 months. All right, current exchange rate is $1.32 per British pound. Of course, management is concerned that the pound might depreciate against the dollar. And of course, here we're in a U.S. company. What's the worst thing that can happen for U.S. companies is that the dollar gets stronger, because then when you sell your product overseas, you turn those foreign currency units into fewer U.S. dollars when the dollar is stronger. So the worst thing that can happen in terms of currency risk to a U.S. company is for the U.S. dollar to be strong. Well, so just like the farmer is exposed to commodity price risk, here this U.S.-based company is exposed to a currency risk or exchange rate risk. So what's the easiest way to do this is to enter a forward contract. So notice in that third block point, let's suppose there's a forward contract with a forward price of $1.30 per Great British pound. All right, so what happens is that with this forward contract, the US-based company is guaranteed to receive $13 million in 6 months. Guaranteed based on the terms of this contract. Now, this is what we know about forward contracts, is that whenever you use a forward contract, and companies use these all the time, and well, they should, but companies will always have a sense of pride or a sense of regret on the maturity date of the contract unless the spot price on the maturity date of the contract is exactly equal to the forward price, which of course hardly ever happens. So look at my final two circle points here. Suppose the company does not hedge the position and the exchange rate in 6 months turns out to be 125. Then the company would receive just the 12.5 million. Okay, so here, if we have that forward contract, what did we do? We're guaranteed to get 13 million. We would only have gotten 12.5 million. So we're very proud. We stand there and we pump up our muscles and we say, look at how smart I was. I locked in that price of $13 million. On the other hand, suppose that the rate turns out to be $1.35, and we would have received $13.5 million, but we had signed that contract and we only get $13 million. Now we say, oh, McFly, why did we do that? And so we lost out on that $500,000. So remember this about forward contracts. There's going to be a sense of regret. There's going to be a sense of pride, one of those two. But here's the great thing about this currency management is that businesses are willing to tolerate experiencing that sense of regret, because over the next 6 months, this US-based company can do whatever it is doing abroad. Maybe it's selling t-shirts, maybe it's selling chocolate, maybe it's selling technology or financial services, or in the case of you guys, maybe you're selling risk management services. And so you can focus on your core business and not have to worry about the volatility of exchange rates. After all, if we're selling chocolate over in England, what do we know about currency values and appreciations and depreciations? We might know a little bit about it, but we don't want to work as hard as we can and sell as much chocolate as we can over there. And then when we repatriate those funds, just have this many US dollars, right? So we want to focus on our core business, and that's why companies use forward contracts for hedging. Now, how about futures contracts? And so this works almost exactly like forward contracts, but when we're talking about speculation, we have to make the assumption that we don't have a position in the underlying asset. Like, what did I say to you in that previous slide? We were a U.S. company, right? So we had a position in the U.S. dollar because we were selling chocolate in some foreign country. The farmer was a farmer, so he or she naturally has a position in the corn market. Kellogg's naturally has a position because it buys corn and wheat and sugar and cocoa and all that kind of stuff. But that doesn't mean that you have to have an underlying position in that secondary spot market to be able to go over to the derivative market and bet. And this is what speculators are doing. They're making bets on the market. So what are hedgers trying to do? Hedgers are trying to reduce their exposure to commodity price risk or market risk or some kind of a risk. Now, the awesome attraction for speculators is the ability to leverage, right? And so in a futures trade, all the speculator has to do is come up with that initial margin. And remember, that initial margin is his or her own money. And lots of exchanges will enable the use of treasury securities to fulfill those margin requirements. Oh my gosh. And so what can happen here? These gains or losses can be quite large. I mean, they can be huge. If you haven't watched Trading Places, then go back and watch it. It's one of the great comedy movies of all time. Although I'll tell you a quick funny story. I took my students to the New York Stock Exchange one year on a bus, and they said, let's watch this movie, Trading Places. And I had been used to watching it on television, and they brought a DVD, and I had forgotten that there are some non-G rated parts to that movie. So if you watch it, remember that there's some language and there's some other stuff that goes on in there. But clearly it's worth it. Eddie Murphy and Dan Aykroyd, they can buy this huge boat at the end of the movie. Payoffs are symmetrical because the daily settlement requires that the gains from one person accrue from the losses to another. Now, of course, the speculators are going to settle these contracts before maturity. I mean, Eddie Murphy and Dan Aykroyd, they had no interest. They had no interest in selling orange juice in that movie. All right, how about option contracts here for speculation? So let's look at the bottom left graph. If we buy the call option, that means we're long the call option. What's the most we can lose? The most we can lose, as I've said before, is the premium or the price of that option. That is the horizontal to the horizontal axis, that red line there that goes arrow to the left. And so when the price is really, really low, like $0, all the way up until the strike price or the exercise price, that's going to be your maximum loss. But as soon as the exercise price, as soon as the stock price gets above that exercise price, that's when we start going up like this, and we can go up and up and up. Notice it says there's an unlimited profit. Now that break-even point is going to be the strike price plus the price of the call option. Now, for the short call, all we're going to do is and let's try not to get vertigo, we're going to take that graph on the bottom left, and we're going to do this. We're just going to flip it. If we short the call, that means we're selling the call option today, which means we receive the premium. So as a writer or the seller of a call option, what's the best thing that can happen to us? The best thing that can happen to us is that the person who bought the call option from us, we never see that person again. That means the stock price has fallen. That means we get to keep that option premium. So that's our maximum profit. But then what happens if the stock price goes up? Well, that's why we go over here, and then we go down, and we go down, and we go down. And that's why it says unlimited loss. Now here's a really super simple example of arbitrage, and we'll get into more complex conversations as we move along. But remember arbitrage, it requires no investment, it requires no risk, but it has a positive expected return. So notice I have an arbitrager attempts to make a risk-free profit by buying the asset in a cheaper market and selling it in the overpriced market there. And there I have an example for $200 and $198. The important part here is that because capital markets and commodity markets and derivative markets tend to be highly informationally and operationally efficient, these arbitrage opportunities are short-lived. What kind of risks are there in derivative trading? All right, of course, there's market risk, just like there is for almost every other security out there. But remember now, we're signing a contract, so it's a legal and binding contract. So there has to be counterparty risk, which is the risk of default on the contract. Now remember, when we go to an exchange, we have this clearinghouse corporation, this clearinghouse person who then writes a separate contract with us. And the clearinghouse people, they have lots and lots of money, so the risk of default is probably not as high than counterparty risk is in the over-the-counter markets. Liquidity risk, of course, on the exchange is not too big, but in the over-the-counter market it can be. And there are bid and ask prices as well. And these bid and ask spreads could be so large to represent a substantial cost. And then there's operation risk as well. Remember, the bid price is the quoted price, or the highest price at which a dealer is willing to pay. Offer price is the asking price that they're willing to sell. The difference between those two is known as the bid-ask spread. That's the difference between the offer price and the bid price. Remember that the bid price will be lower than the ask price. There's a couple differences in options down there. I bet you know those. And that takes us through Chapter 4. We'll talk at length about futures markets next chapter.